diseases with a certain hospital admission and various emergency admissions as well. So if we can predict a blood pressure going to be high in next few hours or so, then you can treat it, and that means you can avoid a lot of hospital admissions and emergency calls. So one of the way we can looking at measuring the plus transit time. And what's the plus transit time is the time it takes from blood to move from one data point, from one point to another point. So that could be anything. Blood moving from your heart to any limb, maybe your hand, and the distance is traveled and the time it took. It could be just a 2 points on your hand. So once you know that the pulse transit time, so how fast that pulse is moving, and then you know the distance, then we have this kind of theoretical formula by which we should be able to measure the blood pressure, or estimate, probably an appropriate word, we can estimate the blood pressure. But the problem is, again, so we built a watch, we built a device, which wearable device, you can, which looks like a watch. So you wear it on your wrist. It has the two PPG sensors here. So we know the distance between these two PPG, and then if we can measure the pulse coming from one PPG, and then the time it took to go to the second PPG. So then we know the distance, we know the pulse travel time. So theoretically, we should be able to measure the blood pressure. But the problem is the data is very noisy. The data coming off these PPGs, they are very noisy and they're not stationary. It's very difficult to calculate the peaks and valleys. So so we have been working on a number of methods, and one of the method that we published in one of the conference is using the whole peak, taking the whole peak movement into account. So usually, to calculate the pulse transit time, you either need to calculate the distance from one point to another point. So you could take peaks, you could take valleys, you could take any maybe a data point somewhere in the middle between the peak and the valley. So these are the existing method. But the method we proposed, basically, we said, okay, maybe take into account the whole peak, and then shift of the, like, instead of saying the whole peak, they take the whole wave. So first you kind of estimate the whole wave and then calculate the shift of the whole wave, rather than just trying to find out where the peak is. So in this one, basically, we have a moving window. We validated our method with the ECG, because ECG tends to be a very accurate method to measure heart rate. And we know that if the ECG is going up, so we should be looking a peak somewhere close by. So we use kind of a moving window method and try to estimate whether there's a wave or the peak is available or not, and then we just label it yes or no, that is available. So I wouldn't go into the machine learning and deep learning algorithm into the details, because I'm sure every one of you know different methods like LSTM, different type of RNN, GRU, and deep learning methodology. And then, everybody can do a little bit of tweaking onto those methods, and then they say, I've got a new novel method, so everybody can do that. So that's why I'm not going into much details over there. I'll just give you an overview of the technology and the methodology, the way we're dealing with it. Right. So the whole home take idea here, when you're measuring the distance of peaks, some sort of sensors data, so then a widely used method is to find the peaks and the valleys and look at how much it has moved. So the method we're proposing, basically, you just take the whole thing, the whole wave, and then try to work it out, the shift of the whole wave, right, rather than the one data point. So another example, I'm going to go through time series prediction on the financial markets. And lately, I've been doing a lot of work with the stock price predictions, forex price prediction, commodities, and these kind of asset classes, if we can predict their price movement in the future. So we can see there are certain trends, like you would have seen the Bitcoins going crazy up and coming down like a crazy. And similarly, other altcoins behave similarly. Similarly, in the stocks, we see prices going up and down all the time. So can we model them? Can we do some sort of predictions what's coming up? So it's been believed for decades that the markets are efficient, the financial markets, especially the stock markets and these forex markets. And whatever the price that we get on a certain point of time is the accurate reflection of all the available information, right? So that means this efficient high market hypothesis claims that you cannot beat the market. What does it mean? That if the stock market goes up 10% annually, then the best you can do is to gain that. Just buy the stock, hold it, and then you'll get a 10% per annum or something. So because the whenever the price changes, it is the reflection of any available information of the asset class. But people been for ages, or like almost 100 years, people been trying to beat that efficient market hypothesis. They're trying to beat the natural gain, which is usually considered to be the 10%. They want to gain more per year. And one of the famous theory in this domain is Elliott wave theory, where it suggests that when the market goes up, it goes up in 5 waves, 5 pulsy waves upward, and then the corrective waves, 3 waves downward. And similarly, when the market is bullish, the market going down, it again tends to give you the similar 5 waves downward and 3 waves, corrective waves upward. So the theory basically tried to suggest that it's the prediction of the market movement is possible, right? So now there are two theories, and people like always try to work using Elliott theories or some other theories and try to beat their growth. And for that, most of the many market leaders who are trading, doing the investment, they tend to do two type of analysis to beat the market. They do the fundamental analysis. In the fundamental analysis, you look at the company's revenue growth, the market profit, like who's the director of the company and what are their future plans. Two companies merging together, doing something big. People know that its value is increasing, and that pushes the price up of a certain market. And if there's an expectation of a big revenue growth for certain company, then the price of that certain stock goes up. So people always look at these fundamental things to predict the big movements in the price. So the other thing that people try to do is look at the technical analysis. In the technical analysis, you just look at the chart, look at the price movement, the historical price movement, and based on that historical price movement, the hypothesis is what happened in the past will probably happen again. So you learn the patterns from the past, and if similar patterns comes up again, then you envision that the price will behave similarly as it has behaved in the past. So for that, you do a lot of indicator calculations, and many of these and indicators are some sort of moving averages, trend lines, and channels, and momentum indicators. So I'll give you example of a few famous indicators. Many moving averages, moving average convergence, divergence. MACD is a very famous one. Bollinger Bands and relative strength index. So just to get an idea of what do we mean by these indicators and how can these indicators help in predicting the market. So let's look at this chart. So this is the green and the red candles here. They are the actual price of a stock, right? Uh, so now the line here, the pink one and the black one, they are the moving averages. And here on the bottom, we have a MACD. So now look at how the MACD can predict the price movement. So whenever there's a crossover on this center zero line, then the market reflect the movement going up. Whenever it crosses from bottom to up, the price goes up. So you see, so that signal came up here, and then the price went up. And similarly, when this MACD crosses from top to bottom, then the likelihood of price going down in the future is very high. And as we can see, this crossover happened at this location, the arrow, and then the price went up. So another indicator is RSI. Whenever the value of the RSI is very low, then after that a lot of buy happen, and then the price goes up. When the price goes up in the future, the RSI value becomes very becomes on the peak, and when that happens roughly or goes beyond 0.70, then there's a likelihood of a lot of sell happening, and then the price will tend to go down, right? So that's the idea. But the thing is, it's not that easy. If everybody can just look at these two indicators, then they can do the trading and everybody could be millionaire, right? So it doesn't follow these rules all the time, but it does happen. So how are you going to do that analysis? How you can employ machine learning, deep learning methodology to predict the price movements, right? So what you're going to do, you'll extract the data from whatever market, whatever asset, all asset classes, stock, Bitcoin, like your forex prices, commodity prices, gold, oil, gas, all of them have this kind of price, this kind of data. You have an open price at a certain day or certain time. You have a highest price, you have a low price and close price. This is called OHLC, open, high, low, close prices. So if you want to just use the close prices, now depending on what type of analysis you're going to do, I'm just showing you how can you label the data. So just take the close prices, and then in taking that close prices, you can create a 1D array. Like these are 1, 2, 3, 4, 5. This means that the close price is at the first row, then the second mean the close price at the second row, third mean close prices at third row. Then you reshape this data into this format, like create an array of 5 data points, and then take the value from the 6th row and then use it as a target. So basically what after this reshape, what we're going to do, we trying to train our algorithm to read the first 5 values and predict the 6th value that coming out, right? So that's a one way of doing this. And this is, if you want to do this, is the kind of regression analysis, predicting the next day closing price. Yeah. So you can also, rather than labeling with the 6th price, you can also label with the 10th price. Like you saying that I'm reading first values, so first 5 values, and then you label it with the 10th value, right? So that's more useful. But most of the research paper that you'll see, they predict the close price of the next day, next bar. Another thing which is more useful is a classification problem. You can turn this regression problem into the classification problem. You just you say, I'm going to look at the next 10 values, and if the price goes increases one greater than 1% in the next 10 days, then you're going to label this as a buy. And if the price reduces 10%, then you label it as -1 or sell. And if the price keeps in between these two numbers, like greater than -10, less than 10, so then you just hold, you basically do nothing. So similarly, you can label each of this row based on what's happening in the next 10 days. And then you try to train and then do the prediction based on that. If you calculate a lot of features, so these features mean this feature 1 could be the close price, yeah, and then the feature 2 could be the MACD, the indicator that I showed you before, and then the feature 3 could be the RSI or many other features. And then you can make these 2-day arrays and then create a sliding window kernel which gonna move it around the time, and then you continue to pick up the labels from the data. So the idea is basically you, depending on the type of labeling you're going to do from this data, so you can predict the next day close price or what's going to happen after 10 days, right? So, and then similarly you can create a 3D arrays, and then using this 3D data you can predict what's going to happen next, right? So, and then you can employ all the machine learning, deep learning algorithm, mix and match, different algorithms, and then do your prediction. So I'll just quickly show you a couple of examples from our paper. I'm running out of time because I've been told should be finished in 30 minutes. So one of the paper which we recently published in this IEEE transaction on AI, where we produce the patterns, like all the patterns that happens, the price either continue to go up, or the price go up and then stay, or price goes up, come down, price goes up, down, up, price don't change and then go up, price little don't change, go up, remain same, price remains same, go down, price remains same, go down, then remain. So you see all these patterns happening in your data. So we created these patterns, and then we generated the feature from our data. We looked at during the training what the data look like, the similarity with these features. And then based on the similarity metrics, obviously you've done your labeling the way I defined before, and then you do all your sophisticated deep learning algorithms. I'm not going to go into those details because all of you are good with that, you can do that. But the main thing is look at the idea, like you generate the patterns that happens, and then you basically try to fit that pattern, try to learn when that pattern happening, so then hopefully the future price will follow the pattern that happened in the past, right? Another couple of quick examples in this paper, again, like so many deep learning algorithms, the novel idea, the interesting idea here, basically when we're doing the training, so we extracted the error, and then on that error we done another training and try to minimize that error in doing that prediction for the next day close prices. And then in this another paper, we also employed a lot of rules from the trader. Trader employ a lot of rule-based trading, and then they also work with minimizing their drawdown, the prices going, the risk that they take. So adjusting the risk and the profit And using the genetic algorithm, we show that we can beat the market and we can do very well. Another interesting idea is look for certain indicators, look for certain events that happening. Here we came up with an event of a zigzag, event number one. And after that event number one, if a crossover of 144 and 134 happens, so if two events happen, so then we predict the pullback of the price. So is we're predicting quite further in the future. So what we believe that just predicting the next close price or next few days close price is not really helpful. Actually predicting that major event that's going to happen in the future is more useful. So this is the event driven. So details are in this paper. And then after backtesting is also very important. I have also developed some free source backtesting methodology. The code and details are available in these links. And thank you very much for listening. And I believe that's my last slide. And I'm happy to take any questions that you might have now.
Thank you very much, sir. Thank you very much for inspiring and for guidance. Uh, all participants are really enjoyed and inspired from your talk. Now the questions session is on. Anybody can ask the question. If you have any question, you can ask. Participants, you can ask the question. You can write in the chat. I will read the question if you have any. Yeah, sir. I have one question, sir. Yes, sir. So,
Yeah, sure.
yes, sir. So you told that you use the genetic algorithm for prediction. So, these genetic algorithm used with any machine learning algorithm or deep learning algorithm, or alone you have used the genetic algorithm? I
Yeah,
think 4 or 5 slides. Yeah.
yes, the idea of the genetic algorithm here. Go back. Yeah, a couple of years old, basically the use of the genetic algorithm here was to pick the best combination of trading rules for that
Right.
particular point of time. Like different traders could have a different rule. Uh, I'll give you an example of a rule like let's see, this is one of the rule. Like let's say, yeah, this is one of the rules. When the price touches the RSI close to 30, then buy.
Yes, sir.
And if the price touches to around 70, goes up 70, then you sell. So that's the one rule. Then you got another rule when the MACD crosses this zero line, you buy, crosses from negative to positive, you buy. And when
Yes.
the MACD cross from positive to negative, then you sell. So that's another rule. So the actual traders have so many rules. So the genetic algorithm was used to automatically pick up the best combination for these rules. And I believe no machine learning was employed in this genetic algorithm selection of the
Right.
best trading.
Yeah. Thank you, sir. One more thing, sir. Can we fully trust on machine learning for this prediction stock market?
Yeah,
What
there
is your
are many.
experience?
Yeah, but there are many trading houses which are doing complete trading based on machine learning, deep learning, and employing these trading rules. So it's possible. It's happening. It's already happening.
Right, sir.
The algorithms do all the buy and sell automatically.
Right,
Yeah.
sir. Okay. Thank you, sir. From participants, any question you can ask?